So, in this video, we're going to cover the basics of investments. Now, I know what you're thinking, why has the Milky Bar kid dressed up as John Wick and is now giving me investment advice? Now, we're not here to do that, I'm not here to advise you in any way. I'm simply here to break down the various instruments involved in creating a proper investment portfolio. Now, a brilliant way to start would be to break down the different asset classes. There are 5 in total, one of which isn't typically included in the basics of investments because it's a little bit out there. However, we have equities, bonds, property, cash, and alternatives. Now, alternatives is the wacky one, but we'll cover that later. Okay, let's just stop this right here. Before I carry on, I need to cover something really important. You need to make sure that you work effectively with an advisor to ensure an appropriate blending of these asset classes. This is to qualify the level of risk you are comfortable with taking, your investment time frame, and your ability to withstand short-term volatility. If you do feel like you need to contact us at any point, then you can give us a ring or contact us via the website. We're always happy to answer any questions, and you can give us a ring on 0151 520 4353. I will specifically cover how to access these asset classes in a further video, as well as the impact of charges on potential returns. I have to apologise for the short delay, and I hope you accept this picture of Warren Buffett surrounded by burgers as means of remuneration. Let's crack on. So if we begin by breaking down equities, so these are a share in a company. Next is bonds, so these could be government or corporate issue. They're essentially the purchasing of a debt in return for a fixed interest. So you lend a company or a government money, they pay you a little bit of interest, and then at the end of the term, they give you your initial investment back. The next is property. Now, this is very common and very popular. It's a tangible asset, it's bricks and mortar. You can see it, you can feel it, you can sniff it, whatever you want to do in your own time is up to you. Now, the 2 different types of property are commercial and residential. Commercial, you rent into a business. Residential, you rent into an individual. You're wanting to essentially build a home for someone to live in, and then they'll pay you rent to live in it. Now, the next asset class is cash. And we all know what cash is. There's not much point in going into too much detail. The benefits are it's very liquid. The downsides are the purchasing power diminishes over time due to inflation. And finally, we come on to the interesting one, and that is alternatives. Essentially, it's anything like vintage wine, classic cars, exclusive shoes, and even gold. So, the important part, how do you actually make money? How do you make a profit? Now, with equities, you can do this in 2 ways, whether it be the share price increases or through dividends. Now, obviously, when a share price increases, you make a percentage gain. So if a share is bought at £10 and you sell it at 20, you've made 100% profit, you've doubled your money. When it comes to dividends, it's a division of the profits to the shareholders. Now, this is an extremely complicated process, and we're not going to go into it in too much detail today, but essentially, that's all there is to it. It's a share of the company profits. Next is bonds. Now, how you make money through bonds has sort of been explained already. Essentially, you lend your money to a corporate or government body in return for a fixed level of interest. This is typically payable on a monthly or yearly basis, and basically at the end of the term you get given your initial investment back, providing the borrower doesn't go insolvent or default on any of the payments. Essentially, it's a fixed level of income, and then at the end you get your lump sum back. Now, property is fairly simple, and a lot of us will already know how you make money. Essentially, it's a capital gain on the property. The value of the property increased from when you bought it, and then there's the other side of it where you take in a rental income from your tenants. Essentially, you have those 2 components going hand in hand, and hopefully the value of the property increases as well as having a consistent rental income throughout the whole time you own it. Next, we have cash. Now, there is very little opportunity to make any money with cash. It essentially sits there in an account and diminishes in value due to inflation. It's always good to have a bit of a reserve so you can spend it in a rainy day, but you know, at the end of the day, it's just sitting there.
I declare bankruptcy!
Finally, we have alternatives. Now, this is something that's entirely subjective and it is down to the individual. It's something that's heavily influenced by various different conditions, and it's massively complicated. If you think about the difference between a classic car at its peak value and a classic car at its bottom value, you're looking at a difference of well over 1,000% in some cases. And essentially, the only way you make money is through an increase in their capital value. Finally, we need to cover risk versus reward. Now, obviously, with every investment, the higher the risk, the greater the potential for reward. The higher the volatility, the more chance you have of making a profit, but then once again, the more chance you have of losing money. Now, typically speaking, all of the asset classes, you have a chance of losing money. Bonds can always be defaulted on, equities can always go down in value, property prices can always collapse. Balancing risk versus reward is something a professional investment manager does very well. And if you do feel like you would require some proper investment advice, then feel free to give Acumen Financial Partnership a call at any time. We're always happy to answer any of your questions. This has been the Investment Basics, and I'm Daniel Frampton. Thanks very much, and I hope to see you in a future video.